This week, the financial world was rocked by the bankruptcy and takeover of Silicon Valley Bank. This video will be entirely dedicated to that issue. I try to play and show and comment on things that you probably won't see on TV. So hopefully, I will cover it from maybe a little different perspective. So even though if you've tuned in to CNBC or Bloomberg, you probably have been inundated with information. So my hope is to be able to show you things that maybe you haven't seen and a take on it that is probably different than what you might hear. My name is Ben Reppond. Welcome to my YouTube broadcast. Today is March 14, 2023. I'm going to begin with three clips that I've shown before, just brief segments, a very short snip on three segments of people who have made predictions in the past months, either earlier this year or last year, and about what is coming in 2023. And I want to show the connection between what they have said and what is happening. The reason for doing this is to establish credibility with certain people. It's very important where you get your news and who you pay attention to. And I try to pay attention to people who have gotten it right in the past with the hope that they're going to get it right in the future. I'm going to begin with Felix Zulauf. I've played clips from him in the past month, a couple of them in the past month. And one of them, he referred to something that no one else picked up on. And I'm just going to play that short snippet from that. I'm not going to play the whole thing, but just a small piece, and then comment on this. He does predict, as these others do, that there will be a recession in the second and third quarters of 2023. Today is March 14. So we're not yet to even the second quarter. But if he's right, and these are sometimes macro projections, so he could be off a little bit, but he was saying several months ago that sometime mid-year we're going to have a collapse, more than a correction, and then following that the market is going to rally into the second half of the year. And others have said the same thing. So I'm going to notice that. The second thing that really caught, as soon as I heard about Silicon Valley Bank, I literally thought about this. The second thing he said was, what is going to likely trigger a recession is a credit event. And that's the piece I'm going to play, a credit event. And I commented on that and said, what I think that means is a bankruptcy, a major bankruptcy of a company or a country. And here we are. He didn't use the name Silicon Valley Bank, but he described it perfectly. And that is exactly what is leading into, I believe, is going to be a recession that will be for a period of time. So anyway, take a listen at this very brief piece from Felix Zulauf.
I do believe that the US economy will also weaken, it will slow down, and probably have a mild recession in the middle 2 quarters of 2023. But nothing very serious. But in total, it makes for a very weak world economy in the first half of 2023. And US investors should not take too much comfort from that because 50% of the S&P's earnings come from overseas. And therefore, I think 2023 will see a much bigger decline in corporate profits for the S&P 500 than for GDP, or than GDP decline or weakening would suggest. So that's the economic setup. What we do not know is whether there will be a credit event or not. Usually when highly levered economies weaken, usually there are some credit events. Some corporations that have an extended balance sheet and are wrongly positioned, get hit, etc.
The next piece I'm going to play came from a video that I did on December 13 of last year, 2022. It was done and it featured Mike Wilson, the Chief Investment Officer of Morgan Stanley, and he had predicted what occurred in October exactly, right on, and then he is predicting, and they're pinning him down on this. What do you think is going to happen during 2022? What's going to happen by the year end? They're kind of getting close to the year end of 2022. What do you think is going to happen this next year? And what do you think is going to happen by the end of the year? So they pin him down. And so basically he says, and you can pay attention to this in the video, that the S&P downside, the range he gives, I can't be specific, but the range is that the S&P is going to drop probably, if their projection on earnings is correct, driven by earnings. If their projection on earnings is correct, he gives himself a caveat there, that the S&P will drop to at least 3,300 or a maximum of 3,000. What that means, translated from today's number, is that's a drop from today of 15 to 23% more. So that's a big drop. That's going to send us into deeper territory with the stock market. And he says this is likely to occur in the first 4 months of 2023. Okay, we're now 2.5 months into 2023. He's got a month and a half left. But like many of these, he's cautioning, and I would caution also, to say he may be off. What if it's the 5th month, or what if it's the 6th month? I think sitting where he was in December, early December, maybe that's as close a view as he had. But I would say, given what others have said, probably sometime in mid-2023, there is further downside on the S&P 500 and U.S. and probably global equities. Again, if his Morgan Stanley's analysis and understanding of earnings is correct. So take a listen to Mike Wilson.
I think it was October 14th on a Friday is when you came out tactically bullish, 15% rally. It's exactly what happened. I mean, so you nailed that. But 3,600 as a bear case does not seem catastrophic to me, given the backdrop that we've talked about for a while. So I guess what are your earnings number, then what multiple putting on the back of that?
Yeah, but remember, 3,600 is year-end 2023. So our bear case path is 3,000. So, and look, the range we've given people is you should expect a S&P between 3,000 and 3,300 sometime in probably the first 4 months of the year. That's when we think the deceleration on the revisions on the earnings side will kind of reach its crescendo.
I'm sorry to interrupt. 3,000 to 3,300 in the first 4 months of the year. In which case? In any case?
That's the range. I mean, we can't be that precise.
Right. But still.
Yeah, that's a big drop.
That's a big drop.
Correct.
Yeah. Okay.
And that will be driven really by the earnings revisions to the downside, which is the second half of our thesis for this year, which is the ice part of the fire and ice.
And finally, last week I played a piece. I'm going to play again a little snippet from it just to make this point. I played it on Simon Hunt and the British economist, and this is about 30 seconds. And he says at that point, this is earlier in 2023, he says, in the next 3 to 4 months, we will have a large correction in global equity and bond prices. That's a quote. A large correction in the next 3 to 4 months. And I believe he said this about a month or two ago. So again, this lines up with what Felix Zulauf is saying and what Mike Wilson is saying. I'm not going to play this. I played it last week, but he goes on to point out the events that will lead up to a global depression by 2025. So that would push us out a couple of years, and let's give him some room here and say 2 to 3 years. But a global depression. And a depression means a contraction in the economy of 10 consecutive quarters. That has only happened once in U.S. history. So take a listen to this, and then I'll make a brief comment.
I think we have a false dawn. I think that as we look out to 2025, 2026, we will basically see three phases of ups and downs. Between now and the middle of the year, we will have a very large correction in global equity, bond, and commodity markets.
There were others that I played, and I'm not going to play them all. I just wanted to show you those three brief clips. But others included David Rosenberg, Liz Ann Saunders, and Greg Peters. All said about the same thing. Mid-2023, sometime in the middle part of 2023. Let's just stretch it out and say second or third quarters of 2023, that there will be a fairly large correction. And if you line up with Mike Wilson's numbers, it'll probably be something in the 20% range, maybe a little bit less from here. So that is in front of us if these people are correct. I've commented on Jim Cramer. Many people have. He is a horrible predictor of stocks. His job is partly to entertain, and he is an entertainer. But his job, the substantive part of his job, is to pick stocks. And so he picks stocks and says, you know, this is a good one, this is a bad one, et cetera. So he's a stock picker. And he's very smart, and he is an amazing entertainer and a horrible stock picker. So he predicted, this is about a month ago, almost exactly a month ago, that he predicted, or he was saying, you should buy Silicon Valley Bank stock. This is a buy. This is a good price to buy it at. It's got a good run going from here, or however he said it. And so I'm going to play you that clip from a month ago, and you can see what he said. This is an example how horrible his advice is. And there were people who knew that things were starting to weaken at Silicon Valley Bank back at that point. You can find this on the internet, but there apparently is an exchange-traded fund which shorts every recommendation Jim Cramer makes. So its performance is excellent. So it significantly outperformed the S&P 500 just doing the opposite of what he says. And it's so compelling, somebody made an ETF out of it. It's just amazing. But if you like entertainment, tune into Jim Cramer. If you like investment advice, be careful who you listen to. So take a listen to this clip from Jim Cramer recorded about a month ago of what he said about Silicon Valley Bank.
Ninth best performer year to date is SVB Financial, don't yawn. This company's a merchant bank with a deposit base that Wall Street had been mistakenly concerned about. SVB is the old Silicon Valley Bank. Recently bought one of our favorite research firms, Nathanson, and it's become less dependent upon private equity and venture capitalist offerings. Wait a second. Those dried up last year, they could come back. Yes, some of them come back here with the stock directly affects an oversold position. Stock was the fourth worst performer in 2022. I think the fears were not justified, and it's a very compelling situation. Hey, by the way, long-term private equity and venture capital, they're not going away. Being the banker to these immense pools of capital has always been a very good business. Stock's still cheap.
CNBC's Brian Sullivan interviews Herb Greenberg. And Herb Greenberg has gone into detail on the insider trading that occurred at Silicon Valley Bank. I don't know if you're aware of that, but during the past couple of weeks, the CEO sold over $3 million worth of his stock. Sometime in the recent past, I don't know if it was on the same day, but the CFO and the CMO, the Chief Marketing Officer, also sold $700,000 and $800,000 worth of Silicon Valley Bank stock. And I think there were some other executives, I read an article where there were some others who did the same thing. What did they know? Why were they selling these large amounts of stock at that point? And so Herb Greenberg kind of unpacks this. It's very suspicious. And as the government has now provided a bailout for the depositors at least, I'll cover that later. it's curious to me, and I'm just going to say this because I can't prove it, but I doubt that they're going to pull back or undo the sales of that stock or ask them to pay that money back as part of the bailout package. No, these guys are going to get to keep it. Why? Because they're insiders, they're powerful elite, and that's the way the system works. It's ridiculous and it's a shame. But I'm pointing it out because sometimes people don't necessarily see this information on all of the media reporting. So take a listen to Brian Sullivan and Herb Greenberg.
I think there are plenty of insider selling experts who have over the years opined that 10b5-1 plans, as those are known, can be manipulated. Whether that's the case here, it's unclear. If you go back and look at insider
not, by the way, and I want to make
purchases-
it clear, Herb, if not, the timing is pretty impeccable. The 10b5, the pre-planned sales plans were put on for the CMO and the CFO and the CEO. And then a few weeks later, or a month or two later, these big sales kicked in. Now, I want to be clear, Greg Becker, the CEO, had been pretty active buying and selling. But if you're somebody that's gotten wiped out, you're looking at this going, really?
Right, and look, if you look at insider purchases versus insider sales, I went back and looked. I don't think there have been any insider purchases there since 2021. So the sales obviously look suspicious. And actually, I think the SEC is so focused right now on 10b5-1 plans that this will get great scrutiny.
Next, Dagan McDowell interviews Macro Maven CEO Stephanie Pomboy, and she points out, Stephanie Pomboy points out that the issue around Silicon Valley Bank had to do with the fact that it was, I'll say, poorly managed, loosely monitored, loosely regulated, and that the second reason is that they got caught with interest rates rising. They didn't see it. It was obvious, I think, to a lot of people, and as interest rates started to rise, they stayed with their approach. So the investment they made in to protect themselves into treasuries and mortgage-backed securities did not work, and they lost quite a bit of money in that, hoping that was a safe haven for them. Again, missing all of the signs. So, in my opinion, very poor management. And yeah, they got caught at the wrong time, timing-wise, as far as the interest rates go. But my opinion, a very poorly run company. So take a listen to Dagan McDowell and Stephanie Pomboy.
Bring in Macro Maven's founder, Stephanie Pomboy. Stephanie, it's not the first, it won't be the last. Why will this be even worse than 2007, 2008?
Well, I think it's interesting that everyone's characterizing this as stunning in terms of the speed with which this bank collapsed. I think, frankly, the surprise has been that it has taken this long for something to break. I mean, we have undergone the fastest, most aggressive Fed rate hikes in history, far more aggressive than Volcker and certainly far more aggressive than anything we saw that led up to the global financial crisis in 2007-8. And the reality is they're doing it all against a backdrop of an incredibly leveraged economy and a financial system outside the regulatory purview, the part that's outside the regulatory purview of the Federal Reserve, that's been really run kind of like the Wild West. And now we're discovering just how much so. So I do think this is the tip of the iceberg. I think we'll see a lot more stories like this. And then I do think that the problems will bleed out, as they invariably do, to other parts of the market. And I'm thinking specifically, Dagan, about the corporate bond market. You know, a lot of the VC companies that were involved with this bank have been buying up these zombie companies and lathering up debt on them and trying to spin them out. Those zombie companies have over $1 trillion in debt that's going to evaporate. And a lot of people are going to be left holding the bag when that happens. So this is just the beginning of the story as far as I'm concerned.
So next, I want to play a piece from Becky Quick, does an interview with Roger Orszag, and he is the former director of the Office of Management and Budget, and provide some insight into the issues at Silicon Valley Bank, one of which was liquidity, and that the people are now going to have to go elsewhere or they can stay with it. But it's going to be interesting to see how this plays out, because there is a loss of confidence. And even though they can make changes in management, the government can say it's going to back the depositors, people are shaken. So given the opportunity to withdraw their money, we will see how it plays out. I don't know. Maybe they will leave their money there. But I think both the insured and the uninsured depositors will, I still think there's going to be a run on the bank. I still think they're going to, a lot of them are just going to take their money out because there's a loss of confidence in the bank, and I think to a large extent in the banking system. And you could say even regional banks or smaller banks, and that's unfortunate because so many of them are well run and have good management. And I personally deal with a regional bank, and that's pretty much all there is in Montana are regional banks. But anyway, he has some interesting insights in the loss of confidence and liquidity. The other thing he talks about is mark-to-market. Now, that's a term that a lot of people aren't familiar with, but what it means is when they buy a security, let's say a bond in particular, they buy it, they put it on their books at the price they paid for it. If that bond goes up in value, they do not adjust that price to its market value. It's called mark-to-market. If it goes down in value, same thing. They do not adjust their price. So everything on the books at Silicon Valley Bank was priced at their purchase price, when in fact, what happened with their investment in long-term treasuries, which got killed in 2022, long-term treasuries were down at one point as much as 30%. And they had a lot of money. And I don't remember how many billions, but it was a lot of money in long-term treasuries, paying somewhere between 1% and 2% because they bought them when interest rates were very low. They did not ask the question, are interest rates going up from here? If they asked the question, they didn't answer it because it was obvious to a lot of people. I've commented over the past year and even before that. The reason I got out of treasuries as a defensive strategy a couple of years ago was I saw that there was nothing but downside on bonds because interest rates had to go up. If I know this, why didn't they know that? I mean, it seems like they should, and that's a lot of analysts are commenting on this. But anyway, the mark-to-market question, that's a function of regulation. So regulations would have to change to get, a lot of people would like to have this. So it reflects the actual value of various assets, real estate and bonds and stocks and so forth. So it is a current picture whenever they do their financial reporting, let's say quarterly. Not a hard thing to do, but it would give an accurate picture of the liquidity and other things, maybe how good their investments are, or their investment counsel. It says a lot of things, but mark-to-market is a big thing, and I think he, being the former director of the Office of Management and Budget, I think he completely understands the importance of this. So take a listen to Peter Orszag.
Peter Orszag is here. He's the CEO of Financial Advisory at Lazard. He's also the former director of the Office of Management and Budget under President Obama. And Peter, it's an interesting morning. A lot of things we're trying to dig through. Can you offer any help or any insight to kind of point us in the right direction? What do you take out of this SVB situation?
Well, I actually think it is potentially dangerous. So a couple of points. First, let's just look at the direct impact. The most likely direct impact is just on the tech community itself, which has been battered by valuation. But a lot of these companies have relied on this particular bank for liquidity. They'll have to go elsewhere and expect some dislocation from that. But the big question, as you were just discussing, is what more than that? And I point to just two things. One is the core issue here Becky, as you had pointed out, is there are a bunch of assets that have not really been marked to market. And that is a broader phenomenon where when interest rates go up, these bonds that are held and available for sale or held to maturity, the value of them go down. They're not immediately recorded as such, depending on which category in particular. But that is a broader phenomenon because that is not specific to Silicon Valley Bank. And so that's one question. And the other question just involves confidence, a variety of different, the underpinnings of the financial system fundamentally depends on confidence. Waking up to seeing problems at a well-known bank in a particular community doesn't help from that perspective.
Next, Becky Quick also interviews Roger Altman. Roger Altman is the executive chairman and founder of Evercore, a large independent investment advisory firm and investment banking firm in New York. And he's former assistant Treasury Secretary. So he's got an interesting take on this. He says, and I got this off the internet this morning, he says that based on what the government has done by stepping in and guaranteeing the deposits, all of the deposits, regardless of size, so these deposits could be 100 million or 50 million, and they come from, those large amounts come from venture capital funds or hedge funds or private equity funds that are being institutional money that is being supplied and is on deposit at, or these companies that IPO and their stock is at Silicon Valley Bank, or if they liquidate stock, these are in the hands of executives, and they're millions, tens of millions of dollars. And he says by guaranteeing those deposits, what the government is doing is they're making a statement that they will back unlimited deposits of any bank in the future. They don't say that, but that is implied in their action. They're now going to have a hard time, he says, in backing away from guaranteeing deposits. Now we have a second bank as of today. It happened, I think, yesterday. Signature Bank out of New York has also filed for bankruptcy. They were heavy in the Bitcoin space, and I don't know what their activities were and who their investors were, their deposits, et cetera, but so we've now got two, and the government has said they're going to back unlimited deposits in both of those. So when they say deposits or depositors, don't think mom and pop, 250,000, who get 250,000 here per person, and then they go over to another bank and so forth. If they have enough money to do that, maybe up to, a few million. That's potentially a very well-off person, but not in the ultra-rich category. And that's how people play it when they're, in that category. The people that they're talking about that the government is going to back or guarantee the deposits, they're talking about the big institutional money that gets well into the tens of millions. And that's a different game. And so he says the government's going to have a hard time backing away from it, and that regulations are needed in a number of areas that will help prevent this. So that was one of the issues. So take a listen to Roger Altman and Becky Quick.
We want to bring in Roger Altman, who is the founder and senior chairman of Evercore. And Roger, let me just ask you the question that maybe most people tuning in this morning would like to hear. How secure are you feeling in the financial system today?
Good morning, Becky. Well, short term, I think they have stabilized the system, and they did, given the way they viewed the alternatives, what they had to do. Longer term, this is a breathtaking and profound set of events. Here's a banking institution which most Americans never heard of, which was not designated as systemically important, and over a 72-hour period, it threatens the entire financial system and financial market stability. And the banking regulators decide to guarantee the deposit base of the entire U.S. financial system, which is certainly what they just did. Now, this is testimony to a whole series of things, and it also carries very profound longer-term implications. It's testimony to the fragility of finance in the global digital era, when institutions and individuals can move money in seconds by swiping their phones, even if they're 100,000 miles away from the bank headquarters. Right. It's testimony in this case to out-of-date regulation. This institution wasn't seen as systemic. Obviously, given the events of the weekend, it was, and it wasn't subject to stress tests and the tighter capital ratio, liquidity, and leverage strictures, which the biggest banks were subject to. It's testimony to out-of-date deposit insurance. 80% of the depositors had deposits at Silicon Valley Bank, which were bigger than $250,000. Long-term, there's some profound stuff here. If you're guaranteeing the entire deposit base of the financial system, will it eventually lead to less disciplined behavior on the part of bank managers? And if you're guaranteeing the key liability of these institutions, does it mean that there will eventually be pressure to limit shareholder returns?
Okay, thank you for listening to those. Now I want to give you my take on it. I think all of this at Silicon Valley Bank was preventable. And it is very curious that those who were insiders knew enough to sell their stock. I would say just this, because I don't know really what happened other than they sold stock, but I would say connect the dots. Somehow in Silicon Valley and the world of finance, the powerful elite, the management, the executives of banks, and the powerful elite in Washington, D.C., some people call these fat cats. I'll just call them powerful elite. They know enough to always take care of themselves. They give the appearance when they do things like occurred at Silicon Valley Bank that they do not care about the little guy. Even the person with $250,000 in deposits or the couple with $500,000, they don't care about those people. They care about themselves. And isn't it curious, at Silicon Valley Bank, they found a way to take care of themselves. And when they get acquired, I know how the acquisitions work. Because I sold some companies, so I know how this works. When they sell a company, believe me, the executives get taken care of. They get an incredibly rich package, even though they may have been part of the collapse. It's all done privately. You won't know about it, but behind the scenes, there's millions, maybe tens of millions of dollars that change hands, and those who facilitate the transaction, sometimes on both sides, but certainly on the company being acquired side, is their hands are greased a little bit, and they somehow come out very well. The average person doesn't. And that's what happened here. The average person got screwed in this deal. SVP, Silicon Valley Bank, played it fast and loose. And by playing it that way and through mismanagement, you see what happened. The cost will be paid. They'll pass, and it was interesting how they packaged this. The cost will be paid by other banks, but it may go on to taxpayers. I will explain. So they say, the first thing out of their mouth was, this won't cost the taxpayers anything. Oh, I thought, now that's interesting. And before they bailed out the bank or the depositors, what they did was they shopped this. I think over the weekend they made calls to every financial institution, probably in the U.S. and abroad. Anybody was interested in buying this. But part of the deal was, I'm sure, that they would have to make sure the depositors were made whole. Well, with assets leaving, and now you've got a fleeing customer base, you're not going to get that base of customers that banks are used to getting. And I can tell you flat out, not a single bank took the bait. Why? Because the government had to step in. That's why they wanted a bank just like with Washington Mutual, J.P. Morgan Chase came in and bought the Washington Mutual, and that's the way they want it to happen. They tried desperately to make that happen. But because the company is such a garbage asset right now, they could not find a single one. They didn't call me and tell me that. I just know it because they went to the plan B, which is the government steps in. Now, when they do that, they said, okay, what we're going to do is we're going to surcharge or apply a fee or surcharge or tax to other banks, and the banks will pay for this. Well, the minute the government gets out their checkbook and starts writing a check, if you think you're not going to pay for it somehow, you're mistaken. This is going to flow through the banks. They are going to pass it on to their customers. They're not going to say, management will not say, let's just take that out of our profits. No, they're going to leave their profits intact, and they're going to pass those fees on to customers. You and I will pay for it eventually. Indirectly, we will pay for it. And by the way, we will probably pay for it more under this scenario than if they had just, the government had just funded it without doing that. Because if they fund it, where does that money go? It goes on top of our debt, on top of the $31 trillion we already owe, which we're not planning to pay back. We're not planning to pay the interest. So if they throw another couple of $100 billion on top of that, it's like it doesn't matter. They just keep on kicking the can down the road. But one day, the chickens will come home to roost. One day, that won't work anymore. But today, they passed it on to other banks, and watch your fees. You know how banks are with fees. Watch your statements and watch where you get charged for various things. They'll find a way to pass it on to you. So I ask the question, when I give you things that are of concern, I say, okay, what can you do about it? I'm going to tell you from my perspective what you can do about it. First of all, be aware of who you're dealing with. Be aware of the bank. Do you trust them? Do you really trust them? And if you had been with Silicon Valley Bank, could you have seen that coming if you had asked this question? So be very careful in who you do business with. What I do, I'll just tell you, I won't tell you what to do, I'll tell you what I do. I limit my exposure to the bank. I keep so much money in the bank, not more than I need in the bank, enough to pay my bills and meet the expenses of the coming period of time, but I limit it and consciously do that. And I put the money elsewhere, I'll tell you in a minute. And then I have some physical assets outside of the bank. So I have silver, I've talked about that. And whether you silver or gold or any precious metal, that is outside of the banking system. They don't like that. So that's why they put down the idea of having hard assets. But that's one way you can do it. Secondly, for some period of time, I don't know how long, maybe it's been a year or two, something in that 12 to 24 month period, I have been taking cash, physical cash, out of the bank. Regularly, systematically, taking it out, and I put that and the precious metals, I do not put them in my house. I put them in an off-site location, and I, of course, don't put them in a bank. And those are the ways that I protect myself by having assets that are outside of the system, especially silver. But I also like having physical cash. I remember reading Jim Rickard's book on the death of money, and in that book, he recommended, toward the end of the book, he recommended doing this, having a certain amount of precious metals and a certain amount of physical cash. And do I earn money on it? No, I don't care about earning money on it. That's not the point. I'm not trying to make money. I'm trying to have money that's available to me if I need it in a bad situation. For example, a situation like this, and to limit my exposure to banks. Now, banks are part of our system, our financial system. They're necessary. I value my relationship with my bank. I think there's many banks are good banks, the management are good people. They have good intentions. And so I don't want to cast a kind of a black mark on all banks, because it's good to be dealing with a bank that you trust and that you value and that really does look out for you. But when you get the really the get-rich-quick crowd in Silicon Valley, they're in a different game. I mean, they're in the game of using the system, leveraging the system for their own personal gain. And you now, as the covers get taken off, you now can see how corrupt it was on the inside. And then look for an alternative for digital assets. Now, I'm a financial advisor, and I use TD Ameritrade as my custodian, and I'm a fiduciary advisor with TD, and TD Ameritrade's an independent custodian, so not part of the big banks. So I have moved assets set up an account, not more for money for savings, separate from money for investments, and set up an account for moving money that I want available, liquid. I can even write a check on it. I like having it that way, and they're outside of the banking system and not subject to the things that Silicon Valley Bank was subject to. So that's the way I deal with it. But I think you have to find a way to deal with digital assets and getting cash out, and then make a decision about precious metals. And finally, I would say with all of this, created a lot of risk in the market. And we use an approach called tactical investing. You could call it active management. And we make decisions periodically to go in the market or come out of the market. We last came out of the market on February 16th, and we have been out of the market since. This was a period of high risk, and it was beginning to tell us on February 16th that this is entering a period of high risk, and we got out. We took all of our client managed accounts out of that, and we will re-enter the market when things look better. And that's the way we've consistently done it. It's not perfect. We're not always right. This time it worked out very well. But we do make moves, and that's the way our goal is to protect against deep risk. If you want to talk about that, give me a call. So that is the way, the various kinds of things that you can do with your money, both in the bank or your investments or precious metals, physical assets, ways that you can minimize risk that was present with Silicon Valley Bank. Now, here's a picture, and you might think, Ben, what are you showing here? This is a restaurant, right? Okay, and this lady is looking ahead at probably a monitor on the other wall, right? And I put this on here because this last week I was between meetings, and I stopped at a restaurant for lunch, kind of a restaurant sort of like this. And on the wall were some monitors. I don't have TVs. I got rid of my TVs, so I'm not used to that. So I saw these TVs, and so I ordered my lunch, and then I looked up and saw these monitors. And so I began to watch what was on the TV. And I'm reading the script that goes across the screen. And there were two of them. One was called Euro News, which was broadcast from Europe. I guess that'd be by satellite. And the second one was in the US. It was ABC News. So the two of the monitors are sitting there together. And I don't hear the sound. I just see the script below it, and I see the images. And I watched this until my food came. And I realized the world is falling apart. It's just falling apart. Now, I read the news, and I've shown you some information, but I don't watch TV. So a lot of this is on TV that I'm just not exposed to by choice. And so there are people who believe that actually the events of the world are falling into place. So whether you're of the camp that they're falling into place or that they're falling apart, you can look at the events, and I don't know how you can conclude. I can't conclude that we are yet in and that anytime soon we're going to get into a growth economy. Everything just seems like it's falling apart. And I don't know if you feel that way, but it's amazing. Now, I don't get, because I've told you we do tactical investing, and so we get out of the market, get out of the way of that risk as much as we are able to do. And so I don't worry about that. I just don't worry about it. But it doesn't make me very happy because I'm not making money. My goal is to make money. And this is not an environment to make money. This is an environment to preserve money. But I would like to return to a period when we can get back into the market where we can make money, a growth economy. And I believe that will happen. I don't know when it's going to happen, but as I looked at these monitors, I just shook my head. And after my food came, I didn't want to look at them anymore. That was just enough. Not a very good picture. So I couldn't help but comment on it, and just because I don't watch it every day, it just struck me, kind of startled me, I guess. So, okay, well, thank you very much for watching. Thank you for bearing with me through these various clips that I played for you and my commentary. And if you have questions or comments, leave them in the comment section below, and I will try to answer them. Thank you again for watching.